On Tuesday, one number drops that drives nearly 70% of the US economy. And if it surprises, silver could react within minutes. Look, retail sales account for roughly 70% of US GDP, making it one of the clearest gauges of economic momentum. When consumer spending accelerates, bond yields often adjust sharply in response to shifting interest rate expectations. The 10-year Treasury yield has moved more than 20 basis points in a single session following prior upside spending surprises. Silver, which recently swung nearly 10% in a single day, has shown heightened sensitivity to these yield shocks. In the past 12 months, silver has reacted within the first hour of major macro releases on multiple occasions, underscoring how tightly it is tethered to the rates narrative. The mechanism is straightforward, but powerful. If Tuesday's spending number comes in stronger than expected, markets may conclude that inflation pressure could persist, even if headline CPI readings have cooled modestly in recent months. In January, consumer spending surprised to the upside by more than 0.5%, triggering a swift repricing in short-term rate expectations. When yields rise, the opportunity cost of holding non-yielding assets like silver increases, and capital often rotates toward interest-bearing instruments. That dynamic alone can be enough to pressure metals, even in the absence of changes to physical demand. The dollar's reaction is equally important. A strong spending report can lift the US dollar index, which has traded in a range of roughly 5% over recent months, and a firmer dollar typically weighs on commodities priced globally in dollars. Silver does not trade in isolation. It is embedded in a currency framework where relative strength matters. If the dollar strengthens by even 1% in a short window, it can amplify downside momentum in metals markets that are already volatile. Yet the bond market remains the first responder. The 10-year yield, which has fluctuated by more than 50 basis points over the past quarter, often telegraphs the direction before silver reacts. If yields spike on Tuesday, silver may retrace quickly. If yields retreat, the metal could stabilize. The broader lesson is not that one report determines destiny, but that in a tightly wound macro environment, even a single data point can recalibrate expectations. In markets this sensitive, silver does not wait for consensus. It moves with the first repricing of risk. What makes Tuesday even more important is positioning. Open interest in silver futures has already contracted in recent sessions, and historically, when open interest falls by more than 10% during volatile weeks, it signals leverage is being flushed from the system. That matters, because markets with lower leverage often move faster once a new directional bias forms. Consider this. The 10-year Treasury yield has moved more than 100 basis points over the past 12 months, and silver has tracked those swings with amplified volatility. If Tuesday's report pushes yields even 15 to 20 basis points in either direction, the ripple effect could be immediate. At the same time, total COMEX silver inventories hover near 400 million ounces, a figure that traders watch closely during stress periods. When macro data collides with tight positioning and thin liquidity, even a 1% currency shift or a 0.5% surprise in economic data can trigger disproportionate moves. Silver is not just waiting, it is coiled around macro pressure points.